Okay, now we're recording. Whoever said no recording, thank you very much for that. So, but the cool thing about options as well, they started with that premise. You wanted to protect your asset, protect your stock, or you wanted to take a position in stock in a unique way. Options allowed you to do that. But options also allow you to do some really crazy things. In that, how do you invest? Most investors, you buy stock, you want it to go up. How do you lose money if it goes down? If you're short a stock, how do you make money? If it goes down, how do you lose money? If it goes up, what happens if it does nothing? Nothing, right? If you just own the shares, maybe you get dividends or something like that. But other than that, you don't profit from the non-movement. With options, you actually can profit from neutrality, which make them one of the most insane ways to play the stock market available in my mind. So you can actually profit from a position doing nothing. And for those who sell a lot of options, this is precisely what we do. So what are some ways you can do that? You can take different positions. You can go, not only can you profit from it being neutral, you can also profit in different time horizons. So you can say, well, I think I'm long-term bullish on this in the short term, but I'm actually long-term bearish on this in the long term. So I'm short in the short term while I'm long in the long term. Well, how would you do that with just shares? It'd be very, very difficult to do. With options, you can do different types of spreads, different strategies to do just that, to take a long position in the short term and a short position in the long term. So the complexity of options allows also for a lot of cool ways to profit from it. How does it do that? Well, the options involve Greeks, and Greeks are basically, when you think of a stock, like we said, XYZ, you buy it at 100 and you have 100 shares. Well, how do you make money from that? You make money from that from the delta being the measure of change in the price. So if you have 100 delta, 100 shares, and it goes up $1, you've made $100, right? If it goes down $1, you've lost $100. Well, with options, you have delta, like with stock, but you also have some different Greeks, which make it much more complex, but also like I said, being able to target things in a very unique way. So you have gamma. Gamma is the measure of change in delta. So what causes the delta to change? It's gamma. And if you are new to options, Bullish Bears is a great resource to be able to learn more about those things. Vega, if a stock goes down, you can actually profit from not even necessarily how much it goes down, but the volatility involved in that option price as it goes down. So for instance, what does that mean in layman's terms? Well, if anybody was trading during Volmageddon of 2018, I believe it was February 5th, 2018, the stock market was down that day, but we did not crash. And yet the volatility of the stock market of that day treated it as a crash. Why? Because it was the velocity of movement, along with some other complicated reasons it did it, but it was the velocity of movement of the change, where we were in a regime that had largely gone up, largely not done much. Suddenly we have a pretty big down day and volatility exploded. So you can profit from the velocity of movement, the volatility. You can profit from the time, the theta. And if you've sold strategies, this is largely what we're profiting from is options decay. You buy an option contract and there's an expiration date. It does not go on forever. Once that expiration date has passed or expired, if it's an individual equity, you might either own the stock or have sold the stock at that point, or if it's an index option, it's expired to cash. So time is a big factor in option contracts. The other part that was not a big deal for years, for the last couple of years, but now is starting to be interesting again, is the Greek rho, which is the price of interest rates and how that affects option prices. So you have all of these Greeks that have the ability to play against each other in order to create some pretty complex strategies. So why backtest an option strategy? Well, you would backtest a strategy to see how a strategy has performed historically, or it might perform in the future. And so you can see some key metrics from the past. The nice thing about options is that they're expiring all the time. So you can put a trade on that's very similar through time and get really good historical data about what the win rate was for that trade, that strategy, what the max loss would have been if you had traded that strategy, what the max profit would have been, the averages, all of those things. And it allows you to analyze specific strategies, and then you can adjust something. So you might come in with an idea and say, I think this, for those of you who are familiar, I think just the stock market went up, like crazy the last couple of years, not this year, but the last couple of years, we've been a historic bull market. Well, I bet if I just would have bought a call in SPX or SPY, I would have made I'd be a zillionaire. I would be in space right now, well, we can test that. We can look at that historically and see what would have happened. And then as you come in with that idea and you see what the results would have been, you can quickly adjust strategies to see, tweaking them to see, well, let's get the most performance out of this. If it was a loser, let's turn it into a winner. If it was a winner, let's turn it into a bigger winner. And then you can add some management parameters to kind of help that and say, well, I bought this call, but apparently holding it to expiration wasn't the winner. The winner was to take it off at 50% or 40% or 30%, or to get out at a 50% loss or a 40% loss. You get the idea. You can test quickly and adjust quickly. But there are some pitfalls with backtesting. Most options backtesters use end of day data. And what does that mean? Well, they open and they close all their positions at around 3:50 p.m. And if you've ever traded options, specifically short-term options, you might already see the trouble in that. But they close them at 3:50, open them at 3:50 once a day. And this is fine for longer-term option strategies. Like if you're putting on a 65-day or a 90-day iron condor, that might be fine. But it can almost become useless for short-term trades. And I'll give you a quick example of that. So this is May 12th of this past year, last month, and not this past year, this past month. And the chart looks crazy. For those of you who have ever seen a market profile chart, this is what it looks like. Don't be scared of all the letters and things like that. It just shows the range of the day, which I thought was useful in showing this. But this is just a quick example of why end of day testing is troublesome. So on May 12th, the futures in the E-mini S&P opened up at 38.97, okay? And they closed, so opened at 9:30 a.m., closed at 4 p.m. Eastern at 39.27. And that was a 30-point range. So what would have happened with a standard end of day backtester? They would have seen from one day to the next a 30-point move for the entire day. You put a trade on the day before in the backtester at 3:50. The next day it monitors it at 3:50 and says, okay, it was a 30-point move. Well, like I said, if you're doing like 90 days out or something like that, that's might be fine. But the reality is that during the day, the price oscillated between 38.54 to a high of 39.61, which was a 107-point range. So if you had a 25 delta call spread on, or a 25 delta put spread on, or anything like that, you would have been massively affected by that huge range intraday. Your strategy would have been changed if you could see that data. But the problem is the end of day data doesn't show you that. And so you might get false confidence to say this 35 delta iron condor I put on, man, it just kills it from day to day. Well, the reality is if you don't have really good data, you're missing actually a lot of the intraday moves that might have wrecked you. So because most backtesters use end of day data, they're unable to test strategies that last for less than a day, because again, they're checking once a day. But a lot, especially with the introduction of 5-day week expirations now in SPX, there's a huge opportunity to use same-day expiries to build out strategies. Rather than just do what 15 years ago was end of month, you get once a month on one option. Well, now you have over 30 expirations a month happening, at least in SPX and SPY and things like that. if you're using end of day data, it gets really, really hard to actually profit from that or to figure out an edge from that, because your back tester is just checking once a day and it's missing all those opportunities intraday. So that's why we came up with Option Omega. My partners and I all trade options, and we had come up with some strategies. We are those people I'm talking about. We came up with some strategies that we thought were just, we were going to go to the moon. We were going to have moon parties, lunar landings, things like that. But we were fools and we were idiots. And because what we didn't realize is that the end of day got us. It tricked us. So we started building out our own back tester. We have some of the partners come from a development background. So we started building out our own tester. And we started with 5-minute data, and we realized we needed to go further. So we are the only back tester in the world that I know of, options back tester, where you can test complex option strategies using 1-minute data, which we think for the future bodes really well for people who are wanting to do 5-day-a-week strategies or things like that. So with that being said, if you guys have any questions, you can put them in the chat or whatever. We will show you the app and get started with that. And if you have any questions that I can't answer, we'll go through it and hopefully they answer them. So this is the back tester. And if you look at it, it's pretty simple in the sense that it has a lot of stuff going on. These are tests that I have saved. And when you look at these, we are going to show you in card format or in table format, all of your saved tests. Now, what is a test? Let's create a test real quick in Option Omega. So we're going to create a test. Straight away, you'll see that we have a couple different tickers available. And we just last week introduced IWM and QQQ. And so you can test those now, but we also have SPX and SPY. And so for this demonstration, let's use SPY just because it's super liquid and super fun. So your dates, we go back to 2013. And so you can go back to January of 2013. You can also go to the yesterday's close. So we don't have, we don't have that day's, if tomorrow when the market opens, you can't test tomorrow's action. But if the market was open today, you could test today's action tomorrow, if that makes sense. So what we'll do is, just for the sake of it, we will do year to date. And what we'll do is that through the 19th. Now, today's the 20th. Obviously, market's closed on the weekend, but it's going to go back to the 17th, which I believe was Friday. And we have some common strategies that people use a lot of times. So for this test, what we should do is just do a call. Let's just buy a call. And what we're going to do is we want to test what happens if you buy a call every day. Let's do a 50 delta. Let's just say we're super bullish all the time. So we're going to buy a call in SPY every day. And we are going to unclick this uses at DTE. What that does is it says, just find we put 45 days to expiration. We want to find the closest contract to 45 days. What do all these buttons mean? Well, in this case, we picked from our common strategy selector a long call. And what it did is it populated this for us. We're going to buy a call, one of them. We're going to buy a 50 delta call, and we're going to buy it the closest we can find to 45 days to expiration. I don't want to get too confusing already, but we do have a lot of options in this. So you can also, instead of a delta, choose percentage out of the money. Say, I want to buy a call, not based on delta, but based on like 20% out of the money. It was a dad joke. Thank you. I was waiting for someone to be like, that's silly. A delta, so you can do delta, you can do percentage. You can also do fixed premium. So you could say, I want to buy a call for $3. Whatever delta it is where the option is $3, I want to buy that one. For ease of just showing, let's stick with delta. So we're going to buy a call, a 50 delta call, the closest to 45 days that we can get it. Because we have 1 minute data, you can enter anywhere from 9:32 a.m. to 3:50, I believe 3:58 p.m. Why do we shut off those 2 minutes? Because if you've ever traded options and looked at the market at 9:31, it's crazy. It's insane. It would be impossible for us to really show the most accurate positions possible, the most accurate data possible, partly just because the bid and the ask get wonky during that time. Same thing with the last 2 minutes of the day. Other than that, you can put this, you can open and close this at different times. So for this iteration, we want to buy this call at 9:45 in the morning. This is market time, so Eastern Standard Time. We're going to do this every day. And what we allow you to do is to test kind of portfolio sizing. What you would do with this, what you would try to do in real life. We're trying to monitor it. So let's say you're starting with a $5,000 account. You can allocate a percentage of your account to each trade. So each time this puts this on, let's do 20% of our allocation. Let's up it a little bit just to show that. So we're going to start with 10,000. So every trade, we're going to put $2,000 into this trade. We can have a max open trade. So we could say, we want to do this, but we only want to ever have 3 of these things on at any given time. So we don't ever want to go crazy. And even though we say we want to buy it every day, we don't ever want to have more than 3 on our book at any given time. You can also choose to prune the oldest trades. And what that means is always have 3 at on a time. So I want to put 1 on every day. So just close the earliest one every time I put a new one on, if that makes sense. Just prune them, just get rid of them, keep going, whether it's profit or loss. We'll keep that off right now just to show. Then you can say, if you don't want to play around with your fund allocation, this will actually override that and say, you know what, that's silly. Let's just start with 1 contract at a time. The max contracts per trade. We only ever want to do 1. So forget, let's say I build this up to $1 million account and I'm using 20% each trade. I don't want to buy 4 zillion call contracts in this trade. I just want to do 1 at a time, max contracts. And so that's what we'll do. There's some other opening parameters you can put in based on the strategy. So you could say, I want to do this trade only when the VIX is at least at a 20. So you're going to have plenty of opportunity this year. Or you could say, I only want to do this if it's under 35 or 40 or something like that. So you can enter your trade based on some specific VIX characteristics. We'll keep that off right now. You can also use some technical indicators. So you can do min and max relative strength. You can also do simple moving averages. So you could say, I want to do this only if we're below the, anywhere from 2 to a lot. So we have some different options there. But I only want to do this if we're under the 5-day simple moving average. Or you can compare it. You can say, I only want to do it if the 5-day is over the 2-day or something like that. So there's a lot of different technical indicators you can place these trades on as well. We also have an opening thing called use squeeze metrics. For those of you who are familiar with squeeze metrics, you know what it is. I won't get into that here just because it's a little bit more complex, but definitely look it up, squeezemetrics.com, I believe. They've got some really cool data and some really cool concepts based on gamma that you can, the gamma of the market that you can put trades on. So I'll leave that one there as a goodie for you guys to look at yourself. With exit conditions, this is where it gets really fun. You can say, I want to see what it looks like if I take profit at 10%. So I don't want this contract to expire. I don't want it to just go till the end. I want to get out if I make 10%. In a similar way, I also want to get out if I lose 20%. So I don't want to hold these things and just let them bleed out and expire worthless. I want to get out if I lose 20%. You can also early exit at an early date. So if these are 45-day options, you could say, I don't want to hold this because I'm going to bleed and decay. I want to get out 21 days to expiration or something like that. That's kind of a tasty trade methodology. You can see for yourself whether it works or not in this environment, but let's just, for this sake, do it. So 45 days and 45-day contracts, and we want to get out with 21 days left. So that's our exit conditions. We're going to stay in this trade until we either make 10%, lose 20%, or it's 21 days to expiration. And then for early exit time, you can say, this is especially useful for 0-day options. I want to get out like at 11:30. So I want to test the trade where I get in at 9:45 and get out at 11:30. You could do that as well. You also can get out based on technical indicators like above. So you can get out on relative strength. You can get out on simple moving averages. And then we try to make this test as realistic as possible. And this is the thing, if there's one takeaway from your friends at Option Omega, make these tests hard. You don't want to trick yourself into thinking that you found this thing that is going to make you Warren Buffett, where there's a couple gotchas that you didn't put into place that are going to eat away your profit, and it's not actual good trade. And so we try to add some of those. So for instance, most brokerages are going to have a trade fee. So you could say, so for instance, on SPY, every contract costs $1 and it costs $1 to close. I don't know what your brokerage fees are. That's the point, is we don't know what your brokerage fees are, so you can do it. We also have a feature called slippage. And if you ever want to punish yourself and really see whether this strategy can win, put slippage on. Because what slippage means is if you've ever bought an option, let's say that call, you're sitting at your brokerage, you're in front of your computer, you're about to buy a call. And let's say the SPY call is $3.20. Well, if the market was moving like it does, you might not get filled at 320. So you have this question before you. Are you willing to pay 325 for it? Are you willing to pay 330 for it? And then let's say when you're getting out for a 10% profit, are you willing to take 5 cents less for it, 10 cents less for it? That might be the only time of day you can actually get out if that's the case. And this is especially true for spreads where you're not just doing single options and things like that. So for this one, let's just say, let's punish ourselves real good. We're going to say on each side, let's assume that we get 5 cents worse fill than we're trying to get. Okay, so next up is ignore trades with wide bid-ask spread. So we try our best. We believe in our data. We believe we've done a good job with it, but also options involve risks are not suitable for our investors. And COVID was crazy. Crashes are crazy. When things are moving, derivatives, the liquidity of derivatives gets insane. Anybody who's trading during COVID saw this. And so what we allow you to do is to say, look, you might have got a great fill because liquidity was weird, but you also might have got a terrible fill. If you want to ignore both of those, just to hit ignore trades with wide bid asks, and we won't calculate that. We will show you it, and we might be able to look at that here, but we'll show you it with a line crossed out and say, we ignored this. Here it is. Here's the price we got for you, and things like that. You can go through and you can say, close open trades on test completion. So you can say at the end of this run, say there's 50 of these or 60 of these. Whenever the test is finished, just close everything and put that in the profit and the loss. Don't keep them open because we just want to see where we were at. So that's one thing you can do. You can also, just to punish yourself some more, to make it as realistic as possible, you can say, I don't ever want to see profits beyond what my profit target was. In real life, you might actually get filled for better, sometimes, or you might, if it's a long option, your long gamma, you might get a better fill, or it blew through your profit target on the good way. So you actually got 10% more, 20% more, whatever. We want to ignore that. We want to say, no, just keep it at the profit target. I just, for testing purposes, I want to see that. In a similar way, you could say, cap the loss at the stop loss. If it's an intraday strategy, you know, that might be worth checking. If it's an overnight strategy, we'll do that, but really if there's a gap risks, it's pretty unrealistic to do that. So clicking this one without this one is a way to, you know, to make it more rigorous. Similar, we can say, let's require 2 hits at a profit target. So our tester needs to look and see that price that we're trying to get out at twice before we get out. Why would we do that? Well, if you've ever traded calendars are notorious for this, any type of spread, it'll be bouncing around a lot. And you might look for a minute and say, I'm up. If you've ever seen this through brokerage, it's it's heartbreaking. Man, I'm up $600 for the day on this trade. No, you're not, right? Because if you, as soon as you try to get out of that, it might go back down or something like that. So this says, no, we really want it to make it realistic. So require 2 consecutive hits. In a similar way, I don't want to just get, I don't want to get blown out. This has happened to me before, and it's heartbreaking. The brokerage got involved and all this stuff. I don't want to just get a bad feel suddenly. I have a stop loss set on these options, and vol gets ramped up, and I get a terrible fill, and then some bad things happen. Now, I want it for the testing purposes. I want to see it hit twice. And then if you're selling premium, you can say, I want to use min and max. I want to at least, I don't want to put a trade on. So I'm trying to do this trade. I don't want to put a trade on unless I've got $2 credit for this. I want to do an iron condor, and I don't want to put it on unless I receive $2 credit for it. Or I don't want to put it on if I'm suddenly getting over $3 credit. I want to stay in this lane I'm in. In a similar way, you can use blackout days. So we've added, this was just something we did last week. If there's some days that you know through history that you don't want to test. So for instance, like, I don't want to put these, I'm not going to put these strategies on during FOMC days. I just know that. Well, you can actually go back in time and get those dates and just enter them here in a format that we can show you. And we will skip those days for you. And that way, if you know in that strategy, you're not actually going to run it, you can actually, you know, make it a little bit more realistic. So that is the tester. Obviously, there's a lot to it, and it can go as deep as you want it to go. And we can run a couple different things with it and iterate in a million different ways. But let's run this real quick just to show what's happening. So we're going to run it. And as you can see, it's pretty fast for going through 1 minute data. So surprise, surprise, buying calls with reckless abandon this year has not been the play that we wanted to do necessarily. The P&L theoretically lost 3,600 out of 10,000. We have a terrible compound annual growth rate. We have a pretty big max drawdown. As you would imagine, with a call, a 50 delta call, the win percentage was a pick 'em, you know, it was 50%. But it didn't work out for us in this environment. So what this is showing you is kind of your metrics for each one: your max winner, your max loser, your average winner, your average loser, the average you lost or won per trade. And then we're going to show you how long you were in the trade on average, along with your trades and how many winners you had out of those. And then at the top, we show you what all you put in. So here's the entry and exit conditions and all the miscellaneous stuff you put in. So I'll show you just iterating, and the beautiful thing about being able to iterate quickly. That's a losing trade. That doesn't work at all. So let's go down here and say, I want to see what happens if I do a 20% profit target and a 20% stop loss. How do we do? Oh, we're doing worse now. That doesn't help at all. We've lost more money. Okay, well, let's maybe take that off. Let's do a 50% winner and a 20% stop loss. Let's see how that works. Oh boy, we are going in the wrong direction. All right, let's see if we only take 5% winners and we let the losers go at 20%. We're right back to where we started. Okay, so this is looking, the more we test it, like it's not something that we necessarily might want to do year to date. So let's try something different. And this is the beauty of kind of testing strategies in different market environments. Instead of buying a call, let's just buy a put. Let's just switch it. We've gone from long to short real fast. We're going to do 10% profit target, 20% stop loss. How do we do? Oh, surprise, surprise, we have won this year. How did that work? Well, you won a lot more because it's gone down a lot more. So it's not a 50% at this time. You're winning 71% of the time. You have a lower max drawdown. You know, you're not making a ton, you know, but a compounding annual growth rate of 40%, no one's laughing at that. So you traded 113 times and 81 of those was winners. And then what we show you down here is we give you some charts to show you kind of your funds by date, how high you went and then where you were. So you're at one point you had 14,000 in this strategy. You never dipped below your starting funds. And then we'll show you some annualized metrics of that, which aren't useful year to date, but they get very useful when you're running multiple year strategies. And then we give you a trade log. And what is the trade log? This is where you can see each trade that the backtester put on. So you can say every day, basically, we put this on at 9:45. Here was the put that the backtester found for you based on your metrics, a 50 delta metric. This is how much we paid for it. So we paid, you know, $958 the first time, and we closed it. So here we put this on Monday. We closed it 4 minutes later. And if you put things on early in the morning, sometimes that can happen. Your average days in trade, I always like to look at that, is you're usually in this for less than a day. Now, why would that be the case? Well, you're only taking 10% profit on a 50 delta. So those things are going to move. Those suckers you're going to lose money or make money pretty quickly on it. And so this gives you an ability to kind of go through these, look at these. What were the losers? All the losers, except for one, closed at a different day. Okay, well, that's interesting. That's something we can kind of start figuring out together. What was the opening price on this loser? The opening price was $463, and then the closing price was $468. So it just went against us. And so this is what you can do. You can start just iterating and say, well, okay, a 50 delta did okay. Let's try a 25 delta with 45 days out. How does that work? Okay, that's a loser. It's interesting. So you just keep iterating. You just keep going. You can say, okay, well, let me do, instead of just long options here, let's do spreads. I want to do a 50 delta buy one. And I'm going to show you something cool that allows you to do. How do you create a spread? Well, you could create a spread based on two different deltas, but you can also do something pretty handy here. This link button allows you to make this the parent and this the child. So you could say, I'm going to buy a 50 delta put, and I want to sell a put, and puts are going down, so it's going to be negative. We can sell a put 10 points out. What did we do with that? What we just did is create a 10-point spread. So we created a long put spread that's a 10-point wide. So let's try that. Let's just see what happens with it. Okay, we lost less money on that. Let's try now. Let's switch it. Let's go to the dark side a little bit and do what a lot of people do. Let's, instead of buying premium all the time, let's sell some stuff. That's what we're going to do. So I'm going to do this manually. I'm going to sell a put that's 25 points out. And this time I'm going to go to the dark side for real. We're going to do 0 day. And we're going to sell a put spread, a 0-day put spread. And let's link that. So we're going to buy the put, and we're going to do that 10 points out. Now remember, in SPY, that's a huge spread. So let's not do that. Let's do 5. That'd be the equivalent in SPX of 50 points wide, right? So that's big. And what we're going to do is we're going to take 10% and stop loss 20%, just the same thing. So instead of buying premium now, if you remember options, if we bought a put, we're short. If we've sold a put, we're long. So we're selling a put spread. So what are we here? We're long. We're 0-day long. We're putting this on, and it expires at the end of the day. It's got a couple hours to go against this. So let's see what happens. It's not been a great year to sell a 25 delta put spread at 9:45 in the morning. That kind of makes sense if you've watched the market over the last couple of months. Let's do something different though. Let's do it to where instead of just that, let's get a little more complicated. Let's sell a condor. So this was the put spread. Let's sell a condor, which is a call credit spread and a put credit spread. We're going to link that. Because it's a call, we're going up. So we're going to go up 5 points, a 5-point condor. Let's see what happens there. Still a loser. Now remember, you might be thinking, did anything work this year? We are being very, very prohibitive. Look at the miscellaneous stuff. And I always like to do this in webinars, and people are like, well, shouldn't you show the glory of it? I'm like, I don't want people, I want people to survive the market. And this is the whole point of it, is to be able to survive the market. So we punish ourselves now in practice, like Alan Iverson, we're talking about practice. That's what we're doing. So let's see if we can get this profitable though. Let's just do it together. So we had the 10% profit target and a 20% stop loss. Let's let it run. Let's just see, since it's expiring end of day, let's see what would happen if we didn't have a profit target, but we had a 20% stop loss. Okay, we lost less money. Now, let's go crazy and say 0%, we're going to let the profit run, but then we're going to do 100% stop loss. Okay, we're back down to money. Now we say, I'm discouraged in my put selling. I don't have a teacher. I don't know what to do with the put stuff. Well, you're in good hands because you're at Bullish Bears Discord. But let's say you didn't have that. You say, I'm just going to go with what I know. I'm going to just sell a call spread. You still lost money. Now, this is the beauty of it. Why did you lose money? Why did it go against you so much? Well, a couple different things. You only had a 9% drawdown and you won the majority of time. So out of a $10,000 account, you've more or less, you're down, but you're more or less broken even. That's not good enough. So let's see what we can do with that. Let's say we're going to do a 5 delta call, way out of the money. And we're going to buy the wings 10 points wide. So super, super far out. Why did that go against us? We're just hitting stop losses over and over again. Now, you might think to yourself, well, this is unrealistic. I've been selling call spreads all year for money. This is where it gets fun. Let's switch from SPY to SPX now. And let's put some more money in our account. So now we have $100,000 in the account. Now we're ever doing one contract per trade, so it doesn't matter, but let's see what we can do with that. Should it make a difference? It made a difference. You just lost, more money in it. But hopefully you can see what's happening in it. Let's go back to this real quick. Say, okay, I'm not good at selling credit. Let's go back to buying a put. I want to buy a 50 delta put. And I want to take 10%, and lose 20%. In SPX, something different happened. We didn't let them run. Hopefully you can see just through trial and error how this allows you to quickly test things. So I'm going to go to one real quick rather than keep iterating on losers. Let's show you one that would be a little bit better. So out of these, let's do a 0 day that we have found useful. So what is this? This is a 0 day strategy, and we're selling the 16 delta put and buying 10 points out. We're selling a 10 delta call and buying 10 points out. We open it at the end of the day. We allocate 20% of our portfolio, and we are not really doing that because we're only using one contract per trade. Well, this has been an 83% winner this year. So this is where it starts to get fun with me. And again, I'm Debbie Downer, but would you do this trade? You go through it and like, I found this winner. It kills it. I made, win 83% of the time per contract. Would you do this at the end of the day? Would you do 3:40 p.m. and put it on? Maybe you would. It depends on the type of trader you are. But let's change it and say, instead of that, let's do 10 a.m. and see how it does. This is one that's going back quite a ways. So if you look at the ETA has been 15 seconds for most of them. This one is an ETA going 150 seconds because we're going back a couple years. And what are we doing during this test? We're iterating every minute for years at a time to kind of build out this strategy. And so there we go. Yep, over time, it didn't work quite as well. Let's go back out to another strategy. This is a iron condor, and it's 45 days to expiration. So we're putting it on every 45 days, same thing, 16 delta, 10 delta. There's no profit or stop loss on it. And we're just looking at what happens. What's the average days in trade? Well, a lot of times, because of it's so far out, you traded about 400 times and you just let them expire. Why is the average day in trade so long? Shouldn't it get out? Well, it's not going to get out if you don't have a profit or stop loss, so it's just going to expire. So let's change that a little bit. Let's say, okay, well, a 45-day condor, I just want to do 10%. I just want to see how long I'm in the trade if I get out at 10%. So we'll run that. We'll go back from 2013 and we will look and see what we got going, what cooking. And then I need to finish up to leave some room for questions. Sorry, I just babbled for 45 minutes, but hopefully it's been useful for you. So if you have any questions, feel free to put them in the chat. Okay, that was a winner. So, and you went from 45 days to your average days in trade were 4 days. So to collect on a 45, since 2013, running a 45-day condor at those parameters, at those deltas, taking 10%, you'd make 10% in about 4.5 days historically. So it gives you an indication of what to do. So with that, there's a lot more into it. We didn't even get to go into the concept of portfolios, but hopefully that helps you. So portfolios is simply the ability to combine tests to run them together and allocate different percentages to see what a test would have been. And we put that in there largely for ourselves because we started with the idea of hedging. So now you have the strategy, you want to run a strategy and you can run them together and say, well, I have this long strategy, but also have this volatility play that's going to lose money until it doesn't. That's going to make a ton of money. And you can run those together. So with that being said, I used all my time up. You guys have any questions or anything like that? I'm going to work to unmute you, sir. If not, you can just type them. That's right. House mod. I like that. I'm going into here to see if I can unmute. Okay. Okay, a couple questions. Sorry, I can't unmute anybody. I'm bad at things. There it is. Okay.
All right.
Sorry about that.
That was a
So
pretty awesome walkthrough.
Sorry, I appreciate it. Sorry, I always feel bad. I don't get to everything I want to, but I see monthly fee. The monthly fee is $100 a month or $600 a year. But your boys at Bullish Bear have a deal for you that I can put in here real quick. So if you go to option omega /register/ Bullish Bears, you should be, well, it's not going to work because I'm logged in. Hold on. Do we have that link real quick? If you have that link, do you care to post it in there for them? So let me do this real quick. Can anybody hear me still? Am I still online? There it is. Thank you. I think my internet kicked off there for a second. Sorry about that. Matt's one of our partners. He just put the link in there. So what that link gives you, if you can hear me, is 50% off for your first 12 months. So it goes from $100 a month to $50 a month or $300 for the entire year. So that's a pretty good deal, and they're very generous in being able to get that for you. So I think it's, obviously I'm biased, but I think it's a really important tool for those who want to develop strategies for option testing, especially in this market where, man, just straight up, like going into this year, we haven't seen an inflationary environment like this. And so even our understanding of options have changed watching this year and seeing a compressed, I'm speaking a little bit more complex stuff, but a compressed volatility environment with the down moves that we've seen. We didn't have data for that. But the cool thing about this is every day we're getting the data on this type of market, which is allowing us to build better and better strategies out for this type of market. So it is great to be able to find a strategy that you could run since 2013 and make money. That's awesome. But what we've also found useful is the ability to find strategies that work in environments that we have not seen yet. And so I'm really thankful for Bullish Bears for hosting us. And, if you guys have any questions, feel free to reach out to us. We would love to talk to you. We're nerds and we talk about options all day. This is what we do. So. Any other questions? Oh, wait, I didn't even answer any questions. Yeah, I can do it. Yeah, let me show you a personal trade that I did. I'll just do it live. So let's do year to date and do this. We're going to say, we're going to sell an SPX, a 20 delta. Actually, let's do this. We're going to buy 2 days out a 20 delta put. Okay. And we're going to link it. And we're going to sell against that the put that, okay, yeah, we'll answer this in just a second. We're going to sell a put that expires the next day. So 1 day, 2 day. For those of you unfamiliar with this, this would be called a calendar. We're calendarizing it. We're doing a time spread. we're going to buy a call that is a, actually, let's switch it. Let's do a 35 delta put, and then we're going to buy a 20 delta call 2 days out. And we're going to sell against it, the one that expires in 1 day. We're going to put this on at 3:20 p.m. We're going to put this on right before the last 30 minutes. We are going to take a profit target of, well, let's do 40%. No stop loss. And we are going to do one, and I actually didn't show this, and I'm sorry. We're going to exit when tested, meaning if the price hits our strike, we're going to just get out. You can also adjust that. You could say, I want to get out if it's 25 points away from my strike. But for this test, we're just going to do that. So this is off the top of my head. This might be a terrible loser. No, it works. So I have found personally, again, options involve risk, not suggesting it, but someone asked, personally, I trade a lot of calendars. Always loved calendars, and we have found this to be pretty useful. So that's just one trade off the top of my head that worked pretty well this year. Obviously, there's a lot more, and there's a lot of things to figure out in that. But another question someone asked is, are the SMAs provided in the input, the daily SMAs? Yeah, so I think I understand the question. We don't allow anyone to put custom inputs in, partly because we come from an engineering background, and we have found it very, very difficult to manage the size of data that we have without putting some rules in place that we have built in. And so as soon as we introduce custom SMAs, custom technical indicators, it would actually slow the program down quite a bit. It would allow more customization, obviously, but we believe at the expense of what we're doing. The secret is the reason most people haven't been able to do intraday backtesting is because it's really, really hard. And that's not to blow our own horn, because we find stuff all the time that we messed up on, and we're constantly iterating. But we didn't even think it was possible until we figured out some kind of engineering magic stuff that worked well for this type of problem to solve. But most people can't do 1 minute data because we're approaching 1 trillion rows of data. And in order to do 1 trillion rows of data, you have to model that data in a very specific way that doesn't allow for a lot of customization, if that makes sense. So that's a long-winded answer just to say we don't allow custom inputs, but we are very receptive to people's feedback. So anyone who's been in our Discord for any length of time hopefully knows that we work very hard to constantly be iterating and putting new features in. So any other questions? Cool beans. I'm going to put that link in there one more time for you guys. That'll get you a really good deal for the app if you're interested in it. So if there's no other questions, I really, really appreciate you guys having me today. Let me jabber for a little bit. And with that, we will sign off. So we'll put the link again in the Discord channel, but I hope you guys have a great rest of your day, good trading the rest of the week, and we will talk to you soon. Have a good day.